Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Hey team, Charlie Jewett with Renovating Retirement Podcast. You can listen to that at www.listentocharlie.com. Charlie is C-H-A-R-L-I-E. This video today that I'm bringing you from the Truth in a T-shirt series, and remember, I wear a T-shirt to prove a point. A slickly dressed snake oil salesman, which most of the financial services industry is full of, lying to you will hurt you. I'm trying to prove a point. People need to hear the truth. You need clarity. You need to be able to see clearly like a windshield. You're a genius when you see clearly. I don't want you to fall for the well-dressed people or the fancy offices or the gifts. It's fine if somebody has that and tells the truth, but just to prove a point and be a rebel and a contrarian, I started the Truth in a T-shirt series of retirement planning videos to teach you everything you need to know about retirement along with the podcast. And I wear a T-shirt, and that's just the way I do it. Anyway, this video today will be on an important topic. So what I'm introducing is a short video on whether or not you should be using pre-tax money or after-tax money to invest for your retirement. Should you put, $6,000 a year into an IRA or extra money in your 401k and take that tax deduction that your CPA always tells you to take? Or should you go ahead and just pay taxes? If it's $6,000, maybe you pay taxes on that. You have $4,000 left over or $4,500. And should you invest that in Roth IRAs or cash value life insurance, which both grow tax-free and give you tax-free distributions? There's a 2-question litmus test that'll tell you exactly what to do and improve your retirement. So without further ado, enjoy.
On the screen now, you can see that David Walker thinks taxes are going to double. Well, who's David Walker? Why should we listen to him? David Walker served as the Comptroller General of the United States and head of the Government Accountability Office from 1998 to 2008. Basically, he was the CPA for the entire country. He says we're in deep, deep doo-doo and taxes probably have to double. So I listen to guys like that. So let's look at this. I'm going to pull up a traditional IRA calculator that I just got off online. I typed into Google, IRA calculator, so you can go do exactly the same thing. And let me scroll down here. I said, what if you're 30 years old? And this doesn't matter if you're 30 or 60, 70, or 80. It's the same thing. If you're 30 years old and you're putting in $4,000, let me find my handy dandy pen. I need a pen to write on the screen and circle things for my YouTube video. All right, so you're putting in $4,000 a year of contributions, and since it is an IRA, you get a tax deduction. So you make $4,000 at your job, you put $4,000 in, you're allowed to take $4,000 off of your income, so there's no taxes due. There it is. Lovely pen. $4,000 a year contributions pre-tax. You do that until you're 65. It turns into $491,000 and a little bit of change. But remember what I said on another show, if you have an IRA or 401k, that's not your money. You're in a partnership with the IRS. You have to share that money. You have $591,000 in the account, and some of it is yours. Here's an important statement I'm about to make. If taxes don't change, okay? If taxes don't change, so they're 25% when you're making your contribution, so you're putting in $4,000 a year, saving the 25% tax, which means you're saving, $1,000 a year in taxes. If taxes don't change, they're 25, so they don't go up or down. They're 25% now, 25% when you retire. You end up with $591,000. However, when you take it out, only $443,740 is yours. Remember that number. $443,740 is yours. So if taxes stay the same and you use an IRA, putting $4,000 a year in, and you're saving yourself the 25% tax, over 35 years from age 30 to 65, it'll turn into $591,654. However, that's not all yours. You have a partner. After the 25% tax, because taxes stay the same, you end up with $443,740. Now, here's the magic. The magic is coming. Let's look at a Roth IRA. What if you said, wait a minute, I think taxes might go up, but we're going to pretend that taxes stay exactly the same. So in a Roth IRA, you're doing after-tax dollars. So if you're going to do $4,000 a year, you got to pay taxes on it first, baby. So you got to pay 25% tax, which is $1,000. So you only have $3,000 to put in, not $4,000. Now, those mistaken amateur malpractice advisors who say, oh, in the IRA, you're putting in $4,000, you have more money, it's going to compound and turn into more than if you only put in $3,000. I don't know what accent that was. It was sort of a mutt. If you put $3,000 a year into a Roth IRA, both of these, I'm just saying they grow at 7%, whatever. All right, what happens? Look at this. You end up with an account of $443,740, no taxes due, so you can take all that money out tax-free, and you get to use it. Where have we seen this number before? $443,740. Well, if you're watching the video, I'm going to go back to my traditional IRA calculator. Say, wait a minute. If you put $4,000 into an IRA, extra money, and it grows at 7% over 35 years, turns into $591, but you get to keep $443,000 after taxes, if taxes stay the same. But if you do a Roth IRA, you go ahead and pay taxes on the $4,000 first. You pay the $1,000 25% tax. You only have $3,000 left over. You put the $3,000 into a Roth IRA after tax money for 35 years, from age 30 to 65. Your account ends up being $443,740, exactly the same number as you'd have in a traditional IRA after paying the taxes. People, get this point. Get this point. There is absolutely no difference, none, between using an IRA or a Roth IRA if taxes stay the same. The tools will give you exactly the same spendable money. You will net exactly the same after-tax money if taxes stay the same. The only thing that determines whether you should be putting a whole bunch of money into 401ks and IRAs and saving taxes today, or you should be paying taxes today and putting a whole bunch of money into Roth IRAs and cash value life insurance built for accumulation, the only thing that determines that is your view of where taxes are going. If you think taxes are going to go up, you should not be putting money in IRAs or unmatched 401ks. If your employer's matching your contributions on your 401k, then you go rock that thing, baby. Rock it! If they're matching, 100%, 100 cents on the dollar up to 6% of your income, you do just the 6% of your income. Don't max out your 401k with a bunch of unmatched contributions if you think taxes are going to go up. If you think taxes are going to plummet, you should pay taxes today when you think they're high, postpone taxes to a later date when you think they're low. If you think taxes are going to go up, you should be paying taxes today when they're low, in your opinion, not postponing them to a later date when you think they're going to be higher. Maximize your tax-free sources of revenue or distributions like cash value life insurance and Roth IRAs. Now let me throw in here, one little caveat, not caviar, a little caveat. If you have ripping high income, okay? So I was talking to somebody one time who was the president of a hospital or something like that, making $550 a year with a bonus of $250. So he's making $800,000 a year. I said, well, in retirement, what are you expecting your income to be? He says, I'm going to live on like $120,000. He's going to be in a lower tax bracket. Okay, so question number 2 from the litmus test, he knows he's going to be in a lower tax bracket in retirement, so yes, he should be saving taxes today when he's making $800,000 a year. And when he's making $120,000 a year in retirement, that's a good time to be paying taxes. So for most people, that's not true. Okay, for most people, they're making $75,000 today, and they want to live the same lifestyle they have today, but inflation's going up. So, at retirement, they're going to need $75,000 or $80,000 or $90,000. If your income's going to be about the same or more in retirement, and you think taxes are going to go up, very simple suggestion, very simple teaching today. You should be using Roth IRAs and cash value life insurance. Now, if you don't know how to use cash value life insurance, or if you listen to some buffoon on the internet saying that life insurance is expensive and makes a bad investment, go to my episodes, how to improve your cash value life insurance, the 6 different ways, or the rich man's Roth IRA, Roth IRAs with no contribution limits. You can listen to those episodes. I don't remember the numbers, 43 and 50 something, I think. But anyway, that's all for today. Just wanted to prove to you there is no difference between traditional IRA And Roth IRA if you think taxes will stay exactly the same for the rest of your life, but if you think taxes are going to go up, you want to use Roth IRAs and cash value life insurance. Charlie Jewett out. I think you people are the best.
You can come check me out. If you want to look at my podcast or listen to it, you can listen to charlie.com. It'll point you right there. Gotta love forwarding. Or if you want to see my videos, which you've already discovered, you can watch charlie.com. If you want to come over here and learn from charlie.com, you can be referred to the books I've written. I'm writing 10 books in a year. 2 of them are already out. If you want to talk with me and get on my waiting list, which is worth it, by the way, you got to wait, but it's worth it. Go to talkwithcharlie.com to schedule some time with me to know more about merit planning, subscribe to the newsletter, and all kinds of wonderful information that I send out from time to time. You can go to meritplanning.com. Also, you can go to Twitter, Reno_retirement.com, or Reno_retirement, which I don't think is listed here, but I think it's listed in the description of this video, and certainly the description of my channel, which is meritvideos.com, MERIT videos.com. Facebook is Renovating Retirement and Jewett Wealth Management. What else, baby? I guess Instagram is charlie.jewett. And if you want to snail mail me something, tough luck!